At this conference, I have critical messages. You are the syndication community. A lot of you are aspiring syndicators. Many of you have been syndicators for a while. I have critical messages for you, 3 critical messages, right? The first one is about the fact that no one in the syndication industry needs to utter the word inflation again, and I'll explain why. Second, there is an apocalypse coming in commercial real estate, specifically in the office sector. And the third one, the next 15 months will be distress in the multifamily space. I don't have the time to explain why it's only 15 months, but it's that short, 15 months of distress. So let's talk about those sorts of things. These are killer trends. And at the end of it, I would like to give you a gift. Not the usual sort of tchotchke that's given up on stage, but something that's incredibly beneficial for all of you and hopefully also beneficial for me. I'm going to give you a gift at the end. You know about all the legal stuff, not investment advice. You know, most of you know me already. I think I put this portfolio up there, but what I want to tell you about this is that the last 24 months have been incredibly humbling for me. It turned out I said stuff that wasn't true. I thought I was right. Things about cap rates, things about demand, things about dry powder. The last 24 months, my ego has been ground to dust. And I haven't given up. I'm standing up, I'm dusting myself off and saying, I need to look forward. And those of you that are feeling like that need to do the same, because if I don't, then I miss out on the big opportunity that's on the horizon. But anybody that thinks that their ego is the same as it was 24 months away, wow, you're amazing. Come talk with me. You're under some weird illusions and I need to fix you. I'll skip past this. So, the first one is inflation, right? Everyone, the word inflation is everywhere, right? In fact, the word inflation is pandemic. See what I did there? See? So, to me, I mean, obviously it's because it's everywhere, right? So, Americans think that inflation was caused by some bill that the Democrats put together. No, inflation's everywhere in the world. You see all those countries on the right, they have inflations 10 or 100 times higher than ours. None of them printed any money. Inflation is a worldwide event. Most countries that have inflation didn't print a single dollar. It happened. It has reasons, and let the economists figure those out. But get past it. This is not a political thing. Inflation happened. Obviously, at this point, we've seen the worst, right? That was 9.3 in June 2022. You see a nice, smooth downward curve. But we haven't seen the end of it. But here's the catch. We shouldn't be talking about inflation at this point of time. And this graph, which is a rather ugly graph, is the reason why. So, that black line that's going up, obviously that's the Fed funds rate. It was at 0, and then it goes up, 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 up. And then you see inflation, core inflation, up there, maximizes, and goes down. Now, I study these kinds of things because I'm obsessive compulsive about this. Every time the red line cuts the black line, no one should ever worry about inflation. Because once the red line cuts the black line, there's a word that everyone needs to start worrying about. And that word is deflation. Because every time in US history this has happened, because the Federal Reserve killed inflation, you get into a recession, right? I've been telling people what the Federal Reserve does. So, and people don't get it. So I've come up with a new way of explaining it. You are the US economy. I am the Federal Reserve. We are in a gym, and there's weights, right? And when I started raising interest rates, I picked up the 5-pound weight and started beating you over the head with it, okay? And your head is so strong, sir, that you didn't react, so I picked up the 10-pound weight and I started beating you with it. And then the 100-pound. And right now I have the 525-pound weight, right? 5.25%. And I'm whacking you over the head with it constantly, right? And even though I haven't raised interest rates since June, I still have the 525-pound weight in my hand. And I'm still hitting you over the head at the same speed as June. I am damaging the United States economy, and that is my job as the Federal Reserve. My only job is to put us into a recession, and then my job is to make it as shallow as possible, right? Deflation is what I'm worried about because I am tracking trends. On the left side, I'm looking at material costs dropping. On the right side, I'm seeing delivery times below zero. You know what happens when delivery times are below zero? Supply is in excess of demand. Supply in the United States is in excess of demand, so delivery times are below zero. Commodities signal disinflation. I'm seeing energy, metals, crop costs all come down. And this is my favorite. This is one of my favorite websites, freightos.com, freightos.com. And on the website, you can see a shipping container used to cost about $1,400 for years and years and years. That's $1,400 right there. And then it jumped up to $11,000. That was inflation, right? And today, as you can see in July, the container's $1,493. They've now dropped below $1,400. And you're like, yeah, but they're the same price as 2019. What's the big deal? There was 35% of inflation between 2019 and 2023. So that $1,400 today, it's 35% less than 2019. A fantastic predictor of inflation is shipping container price from the Chinese port of Shenzhen to Long Beach, because that tells you what demand in the United States will be in 3 to 6 months. So my message to you is this. Your job, people pay you a huge amount of money to look ahead, not to look at the present. Stop worrying about inflation. Start thinking about what disinflation does to your portfolio. All right, my second critical message, there is a massive apocalypse coming in real estate, and it's the office real estate apocalypse. It will affect you in multifamily, and we'll talk about that. So first, obviously, you know about this. Remote work is gutting downtowns throughout the United States. 95% key swipes before COVID, 57% today. All that stuff about people going back to the office over the last year, that's just gotten us to 57% because that number is from last month, right? And yes, red states, more people come back. Blue states, less people come back. But even in red states, even in Texas, 27% of the people today are not back to the office, and it's very likely that they'll never come back. Now, when I say that, I don't mean they don't come into the office 5 days a week. I mean that they come into the office 27% of the days less. So most companies are saying, I'm not going to give you a cubicle. I'm going to give you a joint cubicle. You come on Monday, you come on Tuesday, Wednesday, Thursday. If we do that, the entire office industry in the United States is in a apocalyptic decline in demand. We've never seen anything like this, right? And people are like, how much down, Neal? 20%, 30%, 40%? Well, here's a building. It's pretty famous if you live in San Francisco because it's on market in California. This building was sold for $1,000 a square foot. It just sold for $200 a square foot. That is 80% less. The building diagonally opposite is Union Bank. It just sold for 75% below its value. This is just the beginning because San Francisco is hit the hardest. And remember, because office leases are 5 years long, it's a slow-moving debacle. Doesn't change the fact that it's an apocalypse. And it's affecting everything in that market. In San Francisco, once those offices did not come back, the businesses that were serving them have gone into default. On the left side, 2 famous hotels in San Francisco are now in default for $727 million. On the right side is my wife's favorite mall, the Westfield Mall. She loved the Nordstrom. It just closed. $558 million in default. Famous, huge, $100 billion companies are defaulting on debt. And it's killing other businesses. It's affecting other businesses. Goldman Sachs says that the smaller banks, right, so we're talking about this little commercial banks, these are the ones with less than $250 billion in assets. Yes, that's small for banks, right? Basically have 80% of these kinds of loans that almost none of them can be refinanced. And you can see that the sector that has the most exposure is the one with the biggest bar, retail. The sector with the least exposure, no doubt there, apartments. Why? Because we have Fannie Mae, Freddie Mac, and HUD, right? We have our own sources of lending outside of the small banks. Well, Fannie Mae, Freddie Mac, and HUD do not care about retail. They couldn't care less. Their job is to provide housing in the United States, not to provide retail, right? But what happens when all those banks stop lending to these retail providers? What happens when they stop lending to the office providers? No one knows because nothing like COVID has ever happened before. And then there's people who say, conversion is going to save offices. This is a completely nonsensical statement, right?
3% of offices in the United States can be profitably converted to apartments. 3%, right? Here's a study. They've studied 1,000 of them. 3%. For one simple reason. Most offices are square. Apartments need to be rectangular because the code requires that every bedroom have a window. What the heck are you going to do with all the space in the middle? Convert it into a basketball gym? It doesn't work. There is no mathematical way to convert office buildings to apartments. There's no way to convert them to condos. And the people have even told me, we will convert them to self-storage. That's going to really work. Buy them at $4 a square foot and convert them to something that's $1 a square foot. Amazing business model. You're going to make a lot of money.
Bottom line is the people that are studying this stuff, like these guys from Fortune magazine, they're saying this is so unique. It's not like 2008, which was terrible overall, but it was very widespread, right? This is specific in one area, but the areas that are going to be hit extremely hard, like San Francisco downtown, we're not talking about office. We're talking about a term that you are going to become very familiar with, like pandemic or inflation, and that is urban doom loop. And you're going to hear this more and more because now that the hotels have started to fail and the malls have started to fail, this is going to cascade. More businesses will fail in those areas. Major institutional investors, by the way, who are much smarter than all of us, like Blackstone, heard of them? Brookfield, PIMCO, all of these have defaulted already. These are not people thinking about default. They're like, this 500 million, yeah, I'll just walk away from that. What about that 700 million? Sure, I'll just get rid of that too. Because I don't particularly care. I didn't sign on these loans, and my business is $200 billion. I'll just take a $20 billion hit, get myself out of this, and move on and make money somewhere else. That's the reality of the situation, and people are not talking about it. So my second message for you is this. It's not about office. Real estate, all real estate, anywhere near downtowns in the United States are going to be depressed for a decade because what we have seen this time is different from 2008. Because in 2008, right, we had all kinds of structural financial problems. A lot of them had nothing to do with real estate because basically a bunch of people got together a bunch of worthless things and sold them to other people, and then bad stuff happened. But this time, we have a fundamental decline in demand of the sort that we didn't see in 2008. Because offices in 2008 were still full. We didn't see this in 1929 because America was growing. We fundamentally have a decline in demand for a 10-year period. Absolutely no one knows what is going to happen. No one can predict this. So any form of real estate, from self-storage to multifamily to senior housing, anywhere near office core in downtown in the United States is the most dangerous thing that you can do for your investors. Stay away. The last one, of course, near and dear to everyone, is distress coming for that privileged asset class that has three organizations supporting it, Fannie Mae, Freddie Mac, and HUD, basically just support multifamily. They don't care about other asset classes. But clearly, there's something bad happening. But before I go to that, oops, click there. I want to talk about this, right? My life mission is to build 10,000 townhomes in certain very extraordinarily bizarre markets that most of you have never heard of. And my investors trust me so much that they gave me over $100 million to achieve this mission. But that's not enough, because 10,000 townhomes means $800 million in equity and $2.4 billion in total cost. So what I realized is that I don't want to be the guy that does this. I know just about every syndicator in America. And so over the next 12 months, I'll be inviting all of you to 3 Mission 10K conferences to sit down to tell you the story of why this is an outrageously good product, because I have built a lot of things and I've bought a lot of things. This is the only thing that I can say that actually works in today's business environment. So if interest rates never go back down and construction costs never go back down, this makes 18 IRR. Can I say that for anything else that I'm doing right now, and I'm doing a lot? The answer is a flat no. So this is about the power of math. and what it can do to generate predictable returns. Because I've realized that I can never beat this, I've decided this is all I'm going to do. And I'm not going to build 500 or 1,000. I'm going to build 10,000 of these. So come talk with me about this. I'm not pitching you on anything. You don't need to give me any money. There's no educational program connected with this. I just want to talk with you about it so that you understand what it is that I'm trying to do. All right, let's talk about this. Most of you sort of on a peripheral level know this, but you don't know the math. 30% of all properties purchased by syndicators, not everyone, syndicators, using floating debt in 2020, 2021, and 2022 are now bleeding cash. Some of them might be bleeding small amounts, but they're bleeding. And that number, by next year, by July 1st, is going to be 40% of all properties that were purchased in that time frame. And here's another way of representing that. This is statistic from Yardi Matrix, right? Well, the bottom number is the one, and I'll read it out to you because the font's small. 2,500 properties have a DSCR below 1.05, essentially, which means their cash flow is either negative or about to be negative. 2,500 properties. Now, the first thing I want to tell you is, does this mean that there's contagion in the market space? Is this 2008? The first thing I want to tell you is, it cannot be. 2008, the total amount of risk was 8,000 billion. $8 trillion. Hopefully you know how much that is. Today, the total amount of contagion, if every one of these properties goes back into the bank, 2,500 properties multiplied by 30 million is $75 billion. $75 billion, $8,000 billion in 2008. Does that seem like something that compares? No. And you might say, yeah, but it's $75 billion, Neal. Right? I should have done that. $75 billion, Neal. Right? And the answer is, yes, but what is the size of the overall multifamily market? Right? There's 2,500, sounds like a lot of property, because these are big properties, right? 200 units each. That's a lot of units. But there are 105,000 properties in the United States. There are 19.2 million apartment units in the US, just in the larger sector. I'm not counting the small ones, right? 19.2 million, 105,000 buildings, and the contagion is 2,500. It might go up to 3,000, by the way, right? That's less than 3%. So is this a multifamily problem? No. Is this a syndication problem? Heck yeah. Because the syndication industry is only about 5% of the total multifamily market in the United States. So if we're 5% of 105, that's 5 or 6,000 units. That's almost half of our portfolio. This is a multifamily syndication industry problem and a multifamily syndication industry distress model. All those people that we used to proudly talk about in our PowerPoints, do you remember having slides saying, there is record dry powder in the United States for multifamily? We were all saying this proudly 2 years ago, right? Record. There's trillions of dollars sitting on the sidelines. Do you remember that? Yeah? You know what we should have really said? What we should have said? Right? There's a bunch of smart people sitting on the sidelines because dumb fucks like us are buying properties at 3 cap. It's harsh, but you have to be truthful about these things, because that is the only way you do what David Green wants you to do. You elevate yourself, you dust off the dirt, and you move on. You move on because the opportunity is incredible. I don't care if you have 5 properties that are bleeding. There's still an opportunity in those 2,500 units, and we'll talk about that. And it's starting now. It's just the very early stages. You heard about this, $229 million default. My friend James Eng says there's a building selling right now for $35 million in Dallas. It was purchased for $47.7 million. Unquestionably, every single dollar of investor equity has been destroyed, and the bank will probably lose $4 to $5 million. This is a sample. What markets are hit the most? Phoenix, Boston, Raleigh-Durham, Charlotte. With the exception of Milwaukee, these are boom towns. All boom towns are hit hard. And then rents are not helping. We were just running around with everybody saying, dude, you know 2021 and 22 was the highest rent growth in American history. And now we've had a year with 0 rent growth. If anyone, by the way, has said to people rent growth in the last 12 months was 1% or 2% or 3%, you lied. It was 0. Actually, minus 0.2%. Now, the right way, the honest way of saying it is, over the last 2 years, rent growth was 0 plus 14 equals 14, divided by 2 years equals 7, with a historical average of 4. Therefore, rent growth over the last 2 years was fantastic. Now you're being truthful, right? But rent growth in the last year isn't helping us. There is no rent growth. And unfortunately, there's a lot of price inflation, right? We have seen operating budgets, which typically we underwrite for 2.5% growth year over year, have gone up 13% in 2 years, right? So we've had 6 years of operational inflation in 2. This means something's wrong with the multifamily industry, right? As it happens, nothing is wrong with the multifamily industry because this is our absorption. We are absorbing 100,000 units in 6 months. Fundamentally, there's nothing wrong at all with the multifamily industry. Inflation obviously is an external factor, right? Nothing is wrong. We have strong absorption. But here's the catch. Deliveries are higher than absorption. So you have strong absorption, and then you have insanely high deliveries. We're delivering, you see 98,000 on the previous slide? Well, that's 199K in deliveries, and that is what is hammering rent growth. Because if you look at the last 75 years, in every single case, including the 10-year crisis from 1974 to 1984, when inflation was high, rents are always higher than inflation. Why? Do you know why? Rents are the biggest component of inflation. Rents are the biggest component of inflation. Therefore, when inflation is up, rents are up. But right now, inflation is up, rents are down. Why? Supply. We have a ridiculously high amount of supply coming in. And right there is your peak, 2024. 2024 is the peak of that supply. Then it drops in 2025. In fact, this graphic is going to be updated because some of those 2025 buildings have frozen. They've stopped, including mine, by the way. I've stopped about 700 units in construction. So that bar in 2025 is going to be even lower. And 2026, because of this, and I can predict this with a very high level of certainty, 71% of multifamily construction in the United States has frozen in the last 12 months. So I can predict with almost 100% certainty that in 2026, we will have astonishing rent growth. Because that supply won't come online. Because you have to start building it now for it to come online in 2026, right? Do you remember the astonishing rent growth that we had in 13, 14, 12, 13, 14, 15, and 16? Well, that's because there was nobody building multifamily in the 4 years before that. It was impossible to get any loans. And we had massive rent growth every single year, double or triple the rent growth. Well, it happened because there was no supply, and we've just turned off the supply valve for 2026. So really bad news for 2024, really good news for 2026. Here's some markets to be very afraid of. One of them, the top one, is one of my favorites. I have properties there. 46,000 units coming into Austin. Just so you understand how bad this is, there's 46,000 units coming into a market that is 2 million people. And the last one, Phoenix, is 29,000 units in a market that's 5 million. 5 million people, 29,000 units, bad. 2 million units, 2 million people, 48,000 units. I don't even have a word to describe that. So good luck, Austin. You're my favorite market, but you're going to suffer. Because as you can imagine, growth is up everywhere, absolutely everywhere. Vacancies are going completely crazy. Cap rates, unfortunately, are increasing in every market in the US. And sales volume, as I said, down 78%, 71%, just like construction. Bottom line, though, and this is my bottom line, this is my message, this is why we should buy now. Most people don't understand that this is why you purchase, this is why you buy. Because renting versus owning, largest gap in history, in our favor, right? I'm going to give you this presentation, guys. All right. Second, household formation, extremely strong because the millennials are reaching their peak years. Dry powder, and maybe I'm the idiot saying this, but remember, these are the smart guys. They will buy when stuff is cheap. And they are going to buy it right now. This hasn't changed. We still have a 4.7 million unit shortage in the United States. And remember this,
If you are the kind of weird people that believe that inflation will stay high for the next 3 years, and you don't believe my story about the Fed hammering and the Fed hammer until we get into a recession, then you must admit that rents will be high over the next few years, because show me one time in the last 75 years when inflation is high and rents are low. With the exception of the last 12 months, remember, you got to look at the last 24. Bottom line, renters are renting for longer. In every market in the United States, people have more debt, they have less savings, they can't buy homes, and that's a tailwind for us. And prices are down 26%. By the end of Q1, multifamily prices will be down 30% from peak, possibly more. My message, if you're a syndicator, and maybe you're feeling bad about what's happened in the last 18 months because you may have said something wrong, get yourself off the ground, dust it off, and go talk with all of your investors, because in my mind, your window of opportunity will only last for 12 months. I don't have the time to answer why, but it will only last for the entire year of 2024, and that's why I am ultra greedy like right now. When my students bought 10 properties in a single year in 2022, I felt horrible about buying one. I'm feeling good about it now, because this is the time of great greed. Now, I know your investors are completely devastated by what's happened in the last 12 months, all the bad articles. So here's what I've done, and here's my gift for you, and I need you to accept this gift. I wrote a fantastic PowerPoint, the most beautiful I've ever written. Maybe they can put it up there on the screen. Maybe you can throw it up on the screen. I wrote this PowerPoint, and I want to give it to every active money raiser and syndicator in the United States, not as a PowerPoint, not as a deck, but as the actual PowerPoint. And yes, it's 300 megabytes. I want you to take this, improve it, play with it, and tell your syndicators the story of why they're about to make the biggest mistakes of their life if they don't invest in multifamily in the next 12 months. Same NOI, prices down 30%. This is the story of why investors continuously mess themselves up, because they get angry at themselves. You're angry at yourself. I get it, we were wrong. It's time to move forward. The opportunity is there. So anybody that wants access to this deck, and I hope all of you do, please come talk with me about Mission 10K, and I will give that deck away to you. I need 100,000 investors to understand why they're making a huge mistake, so we can go make a killing in 2024. Thanks for your time.